We'll be learning about what is a current ratio. Okay, so current ratio is a type of a liquidity ratio. So let us first understand what is a liquidity ratios. Okay, the term liquidity means the short term solvency. Okay, so liquidity or short term solvency means ability of business to pay its short term liabilities. Okay, so when the inability to pay short term liability will affect its creditability as well as its credit rating. Okay, so there shouldn't be any continuous default on the part of business. Okay, that may lead to a commercial bankruptcy. So it's very important to know what is the position of a liquidity of any firm or organization. So for this purpose there are certain liquidity ratios. So out of that the most important ratio is current ratio. Okay, so what is a current ratio? Current ratio is equal to current assets upon current liabilities. Okay, so now let's see what all are included in current assets, that is numerator. Okay, current assets will include your inventories. Okay, then your sundry debtors. Inventories is stock of raw material, finished goods, WIP, everything, right? Then sundry debtors. Then your cash and bank balances. All these are your short term assets, right? Then any other receivables. Okay, other than sundry debtors, if there are any other receivables, okay, or any advance expenses paid, right? Then loans, any loans given, short term loans given for the purpose of business. Then any disposable investment. Now this disposable investment means they are not long term investments. Okay, they can be sold or disposed at any point of time. Okay, so if you note, all these are your short term assets. Okay, short term assets which will be converted into your cash or bank balances, or which can be converted into cash or liquid, or these are liquid assets which can be converted easily into cash or bank balances within a short period of time. Okay, now if you see the denominator, its denominator is what? Current liabilities. So what is current liabilities? Current liabilities means all the short term liabilities. Okay, so it includes creditors for goods and services. Then it includes short term loans. Okay, loans taken but they are of short term, like say if loan is taken for 2 or 3 months. Okay, short term loans means what? Less than a year, we say. Okay, then bank overdraft is also a loan facility which is given by a bank where you can overdraw your bank account. Okay, then cash credit. Then your outstanding expenses expenses which are yet to be paid, which are due but not paid. Then your provision for taxation. Then proposed dividend which is proposed by the company but yet to be paid to the shareholders. Then there is one more, unclaimed dividend. Okay, so unclaimed dividend, what is unclaimed dividend is, dividend is already distributed to the shareholders. It may be pertaining to some last few years. Okay, and some of the shareholders have not claimed their dividend, so it's like a short term liability. You don't know when they will claim the dividend. As soon as they claim it, you have to pay that dividend. Okay, so that is unclaimed dividend. Now if you see, all these are short term liabilities, that is liabilities which are to be paid within the period of 1 year. Okay, that is less than 1 year, right? Now if you look at the current ratio, okay, why it's known as a liquidity ratio, current assets upon current liabilities. Okay, so what does it show? It will show how much percentage of current assets are there as compared to your current liabilities. Okay, so your current ratio ideally should be 2 or more than 2. Okay, if your current ratio is 2, what does it imply? Now let's take one example and analyze how the current ratio will give us the liquidity position of a business. So here is an example. Okay, we have to calculate the current ratio and then we have to analyze the same for both company A and company B. So we are given the following information: sundry debtors 1,50,000 in case of company B, inventories 2 lakh and 1,50,000, then bank balances is 3,50,000 and company B is 50,000, creditors for purchases is 1 lakh, outstanding expenses 50,000. Now if you note, their current liabilities are same, right? Creditors for purchases and outstanding expenses both are same, 1 lakh, 50,000. Now let's analyze the current ratio. Okay, so for finding out current ratio, first what we have to find out, how much is a current asset. So current assets is equal to sundry debtors plus inventories plus cash and bank balance. Okay, so let's see for company A. Okay, sundry debtors, how much is sundry debtors? 1 lakh plus inventories, how much is inventories? 2 lakh plus 3 lakh, 3 plus 2 5 6 lakh. Okay, so 6 lakh is the current assets for company A. Okay, now company B, let's see, sundry debtors is 50,000 plus inventories is 1,50,000 plus cash and bank balance is 50,000. So how much does that come to? 1,50,000 plus 50,000, 2 lakh, 2,50,000. Correct? Now let's calculate current liabilities. Current liabilities is equal to creditors for purchases plus outstanding expenses. So creditors for purchases is how much? In case of company A, creditors for purchases is 1 lakh plus outstanding expenses 50,000. So 1,50,000 is your current liabilities. For company B, creditors for purchase is 1 lakh plus outstanding expenses 50,000. So 1,50,000. Right? Now let's calculate how much is the current ratio. Okay, so company A, current ratio, what is the current ratio formula? Current assets upon current liabilities. Okay, so company A, what is the current asset? Current assets is how much? Current assets is 6 lakh divided by 1,50,000. So how much does that come to? 4. Company B, current ratio 2,50,000 divided by 1,50,000, right? Okay, so how much does this come to? 1.67. Okay, so now if you compare both the companies, you can see that for company A, current ratio is very high. It's very high, that is 4. Okay, very much greater than 2. Okay, why I told the current ratio ideal situation it should be 2 is because when the current ratio is, when will the current ratio be 2? When the current assets are double of current liabilities. Say if tomorrow we have to close all our current assets and liabilities, we should be able to derive the money from our short term or current assets, and we should be able to pay our current liabilities. We should not be using your long-term liabilities or some long-term assets to pay off your current liabilities. That is why current ratio is important. Now if you see in case of company A, current ratio is very high. That is, it has kept a lot of unnecessary current assets. Okay, say if tomorrow company A needs to close all his current liabilities, it just has to repay 1,50,000, whereas current asset balance is 6 lakhs. Okay, so it has a abundant balance of current assets. So it needs to analyze and see where can the balance of the current assets be reduced. Now if you see this 6 lakhs, 6 lakhs has 1 lakh of debtors, 2 lakh of inventory and 3 lakh of cash and bank balance. So what it can do is, it can analyze its cash and bank balance, it can analyze what is the daily requirement of cash and bank, and it can shift some of its funds to long-term investments. Okay, and thereby it will be able to reduce its current assets. Okay, and maintain its ratio of 2. Again, that ratio of 2 is not standard. Okay, it depends upon the company to company and activity to activity. Okay, now if you see company B, say tomorrow company B is dissolved or closed, it has a current asset balance of 2,50,000 and it has a current liability balance of 1,50,000. That is, it has a sufficient asset balance to cover its liabilities. But out of this, sundry debtors, inventory and cash and bank balance, your inventories are not easily movable. Even there is no guarantee that debtors will pay the money immediately. Okay, so it's better to keep a ratio of 2. Okay, now its ratio is less than 1.67. So it's very, the liquidity position, it's tight. Okay, so what it can do is, it can take some funds from its long-term investment and it can increase its cash or bank balance, or it can have some short-term investments or deposits instead of long-term investments and increase its current assets. Okay, this is the way you analyze your position depending on current ratio. Okay, so this was about a current ratio. So it's one of the important liquidity ratios. Okay, thank you.